stay tuned into the newsroom. Let's go across and listen in to Arul Selvan, who's the President and CFO of Cholamandalam Investment and Finance. Let's get him on board. Hi, sir. Thank you so much for joining us today. Well, tell us, the internals don't look very good. The NIMs have declined and the GNPA has increased. There is also an increase in the write-off and provisioning. What is leading to this?
So, in some portfolios, NIMs have marginally declined, and that is reflected. And cost of funds has been steady quarter over quarter, but last year versus this year, the cost of funds is still higher by around 10 basis points. Primarily, this is because of the increase in interest rates that has happened. But we have been able to hold the cost of funds over the last 2 quarters, and we expect to hold it and maybe improve if there are any further reductions that may happen post the RBI's intervention, if any, in Q4. But we expect the yields to improve in the coming quarter. If you see again, between the products, vehicle finance yields have improved, primarily because it was a fixed rate book, and progressively the incremental book that is coming in is at a higher yield, and the contour of the overall book is changing. With the old book, which is of lower interest rate, running off, and the new book with a higher interest rate becoming a larger proportion of the total portfolio, then that way you will see some improvements in vehicle finance yields in the coming quarters. So between these two, the NIMs will more or less hold or marginally improve between now and the end of the financial year.
All right. Mr. Selvan, you also spoke about the cost of fund, but what is your outlook on cost of funds and NIMs and the credit cost going forward? If you can, give us a sense of the numbers.
I don't want to give any forward-looking numbers, but as I said, we will be holding the cost of funds at similar levels. We are right now at around 7.1% of the overall assets. We should be there, and the NIMs will improve maybe by around 10 basis points, is what I would conservatively put it.
Right. Mr. Selvan, how is the overall business momentum? It looks slowing down, especially in the small ticket loans. Also, how is the overall festive mood?
So the festival mood is going to happen or is happening in October, post the September quarter. All festivals happen only in Q3 this year. So the festival mood has to perk up as we move into this quarter. We'll see that improvement coming in. But till Q2, there have been very little festivals, and also another factor which has a little bit hampered growth as well as collection efficiencies, extended monsoons that had happened, which went all the way up to September and even beyond September. So this has delayed the harvest, and therefore the earning potential of the ultimate customer has been impacted in September. That's why you see, not only for us but other players too, that the collections have been little moderate as compared to expectations. So we expect this to change in the current quarter when harvesting gets commenced, and then we see the money flowing in with more loads happening to the transport operators, and the rural economy perking up with festivals as well as the better harvesting yields. The MSP price increase should benefit the customers, benefit the farmers, thereby making sure that there is enough circulation of money in the system for them to pay the transport operators, and thereby we get our collections effectively.
Right. Also, Mr. Selvan, tell us, are the right market conditions and network expansion impacting your OPEX? Is the company compelled to increase its incentives, especially in the home loan segment, LAP, and the vehicle financing segment?
See, there is an increase in branches. We have increased by around 70 branches in this quarter, and that is to accommodate all the businesses as they keep growing. Incentives has increased a bit, especially from collection perspective because of the tightness in the market, and we have increased. But that is more so with vehicle finance, rather I would say, than in the case of LAP and HL. They have been, performing at a similar levels, and their increase in costs would be primarily because of their expansion into newer geographies as they keep growing and spreading to new branches.
Right. Also, Mr. Selvan, your company was anticipating a 25 to 30% growth for FY25, but in the second half of FY25, the high base effect will also kick in, and already there is a slowdown in various segments. Will you maintain the guidance, or are you likely to cut it?
Yeah, we will maintain. See, if you look at the AUM as we talk today or end of Q2, we are at 33% growth. But that would mellow down from the 33% to the 28 to 25 to 28%, which I spoke about. We have factored that, the base of last year being larger and the second half growth percentages becoming slower in the second half of this year. That's why we had given this guidance, even though we have been clocking higher growth in the first two quarters.
All right, Mrs. Selvan, thank you so much for joining us today. We will let you go on that note. So that was the management of Chola.